Have you ever looked at a stock chart and wondered, why are there so many red and green candles? How do traders know when a stock might go up or down? See, if you've ever felt confused by candlestick charts, don't worry, you're not alone. The good news is that by the end of this video, you'll understand exactly how candlestick charts work, how to read them, and how professional traders use them to make smarter decisions. And the best part? You don't need any previous trading experience. Whether you're investing in stocks, cryptocurrencies, Forex, or commodities, candlestick charts are one of the most powerful tools you can learn. So grab a notebook, stay until the end, and let's simplify candlestick charts once and for all. What are candlestick charts? Before we learn how to read candlesticks, let's understand what they actually are. A candlestick chart is a visual representation of price movement during a specific time period. Instead of showing only a simple line, every candlestick tells a complete story about what buyers and sellers were doing. Each candlestick represents 4 important prices: opening price, highest price, lowest price, closing price. This is commonly called OHLC. Imagine a football match. The opening price is when the game starts. The highest price is the team's best attacking moment. The lowest price is when the team struggles. The closing price is the final score. All of this information fits inside one single candlestick. That is why traders love using candlestick charts. They reveal much more information than line charts. The anatomy of a candlestick. Let's break down one candlestick. Every candlestick has 2 main parts. The body. The body shows the difference between the opening price and the closing price. If the price closes higher than it opened, the candle is usually green. This means buyers control the market. If the closing price is lower than the opening price, the candle is usually red. This means sellers were stronger. Think of it like a tug of war. Green means buyers won. Red means sellers won. The wick or shadow. The thin lines above and below the body are called wicks. The upper wick shows the highest price reached. The lower wick shows the lowest price reached. These wicks tell us how far the price moved before settling at the closing price. Sometimes a candle has long wicks. That means the market was highly volatile. Sometimes it has almost no wick. That means buyers or sellers stayed in control throughout that time period. Understanding different time frames. One candlestick doesn't always represent one day. It depends on your chart settings. For example, 1-minute chart is 1 candle equals 1 minute. 5-minute chart equals 5 minutes. 15-minute chart, it is 15 minutes. 1 hour chart equals 1 hour daily chart. It's 1 trading day. Weekly chart is 1 week monthly. Chart is 1 month. Professional investors often use daily and weekly charts. Day traders usually prefer shorter time frames like 5-minute or 15-minute charts. Remember, the candlestick pattern stays exactly the same. Only the time changes. Bullish candlesticks. Now let's look at candles that suggest buying pressure. Long green candle. A large green candle shows strong buying. Buyers dominated throughout the session. This often appears during strong uptrends. Hammer. The hammer has small body, long lower wick, tiny upper wick. Imagine the market falls sharply. Suddenly buyers step in and push the price back up. That creates a hammer. This often signals that selling pressure is weakening. It can indicate a possible upward reversal. Bullish engulfing. This pattern uses 2 candles. First comes a small red candle. Then a larger green candle completely covers the previous candle. This shows buyers have taken control. Many traders consider this a strong bullish signal. Bearish candlesticks. Now let's see signals that indicate selling pressure. Long red candle. A large red candle means sellers dominated. The market closed much lower than it opened. Shooting star. The shooting star has small body, long upper wick, small lower wick. This shows buyers pushed prices higher, but sellers came back strongly. The market closed near the opening price. This may signal a potential downward reversal. Bearish engulfing. This is the opposite of the bullish engulfing pattern. A small green candle is followed by a larger red candle. The red candle completely covers the previous green candle. This suggests sellers have taken control. The power of candlestick patterns. One candle alone doesn't always predict the future. Professional traders look for patterns. Some popular patterns include doji hammer, shooting star, morning star, evening star, bullish engulfing, bearish engulfing. Think of candlesticks like words. One word tells you something. A full sentence gives much more meaning. The same applies to candlestick patterns. The more candles you analyze together, the better your understanding becomes. Why support and resistance matter? Many beginners make one mistake. They see a hammer and immediately buy. But that's risky. Always check where the pattern appears. Imagine a hammer forms at a major support level. That signal becomes much stronger. Now imagine the same hammer appears in the middle of nowhere. Its reliability decreases. Support is an area where buyers often enter. Resistance is an area where sellers usually become active. Candlestick patterns become much more useful when combined with these important price levels. Common mistakes beginners make. Let's avoid some expensive mistakes. Mistake number 1, trading based on a single candle. Always wait for confirmation. Mistake number 2, ignoring the overall trend. Buying in a strong downtrend is risky. Selling in a strong uptrend is also risky. Mistake number 3, ignoring trading volume. Volume confirms whether buyers or sellers are truly active. Mistake number 4, using too many indicators. Many beginners overload charts. Professional traders often keep charts simple. Price action is usually enough. Mistake number 5, believing every candlestick pattern works. No pattern is 100% accurate. Risk management is always more important than prediction. Practical example. Imagine a stock has been falling for several days. It reaches a strong support level. Suddenly, a hammer candlestick appears. The next day, a large green candle forms with higher trading volume. This combination tells us buyers may be stepping in. Would a professional trader buy immediately? Not necessarily. They would also check on market trend, support level, volume risk to reward ratio, stop loss placement. Successful trading is about combining multiple pieces of evidence, not guessing. Final tips for beginners. If you're just starting, follow these simple rules. Learn one candlestick pattern at a time. Practice on historical charts every day. Never risk money until you understand chart behavior. Use stop-loss orders. Focus on consistency instead of quick profits. Keep a trading journal to record every trade. Remember, the best traders are not those who predict every move. They are the ones who manage risk and stay disciplined. Candlestick charts may seem complicated at first, but once you understand the body of D, the Wicks, and the story behind each candle, you'll begin to see the market in a completely different way. Every candlestick reflects the ongoing battle between buyers and sellers. Learning to read that battle gives you a significant advantage. Keep practicing, stay patient, and over time, reading charts will become second nature. If you found this beginner's guide helpful, don't forget to hit the like button and subscribe for more easy-to-understand videos on stock market investing, trading, personal finance, and wealth creation. Have a question about candlestick patterns or technical analysis? Leave it in the comments below. We'd love to help. Thanks for watching, and we'll see you in the next video.